Hey everyone, welcome to the Trendline Investor channel. How to buy IPO stocks or how to buy stocks which are recently listed in the markets and how do you make money out of them? I know a lot of you are holding ZOMATO, PayTM, NYKAA, and most of us are having losses in these IPO stocks, and that's actually not good. So, is there actually a good way to buy these stocks on listing, or is there some other technique which can help you make money buying IPO stocks? So, that's going to be a topic for today, and it's going to be really interesting because I'm going to cover quite a few points which will actually make you realize why IPOs are not really a good thing to buy, especially on listing day for people like us, and how you should buy them. Okay, so let's get started. So I'm starting off with some examples where a lot of us have lost money. Personally, I don't invest in IPOs because I usually I do not buy it before listing because it's just a very small money of 14,000 rupees, 15,000 rupees. Doesn't really make sense. But I do buy it after listing, but after a certain number of days. Now, in this case, I have two cases here, Paytm and Zomato. Now, just observe both the price charts. Now, in this cases, both the cases, in case of Zomato, the price fell almost 70% since listing. And in Paytm, also the price fell almost 66% here in this case, right? Now, these two are some of the most hyped IPOs in the last couple of years, and literally everyone has lost money. If you bought in the start, you would have definitely lost money. If you bought now, probably you would have made some money, but overall, almost everyone who bought and holding till date, at least 95% of them would be losing money. And in order for these prices to go up, in order for you to get your money back, Zomato at least needs to go up 100% to go back to the listing price. And here, Paytm needs to go back at least 200% to get back your listing price, which means if you bought on the listing day, then Paytm needs to go up at least 200% from now in order for you to recover your money. Now, that's quite a big task for a company like Paytm to go up 200%. So actually, how do you buy IPO stock? So here, I want to discuss first thing is let's understand how IPO is actually valued, right? Because that understanding is very much required for you to understand why you should not be buying IPOs on listing day. The second thing is when you should not buy IPOs. We're also going to discuss when to buy and finally how to buy these IPO stocks. So what are IPOs? IPOs are basically when a company actually wants money or when a company wants to increase its brand name or for some other reason they come to public and they ask for money and then we give them money. There are hundreds and thousands of retail investors. We give them money and then they take this money and invest in something else, either to grow their operations, or there are some early investors like venture capitalists or some other shareholders who want to get rid of the shares that they're holding, so they take the money from us and then they sell the shares to us. Right now, that's what is a concept of an IPO. Now, you can just Google if you don't really understand what IPO is. Just Google and you will understand what an IPO is. Okay, but how are these IPOs actually valued? Now, that's a very interesting point because usually IPOs are when companies come to us and ask for money, and these companies actually have investors already in the company, right? So these investors have been investing in the company for the last many years, and they want an exit as well. So when they want an exit, obviously there's big companies who value these companies, and they get to exit at very high prices, right? Because they want good returns. So the IPO prices are inflated and they get good returns because these are HNIs, DIs, and FIs. They really make good money and they sell those shares to us on the listing day, right? Or even before that. Right now, don't want to get into the process as such, but on listing day, we are the ones who are buying the stock. Now, that's not really a good thing because there are HNIs, FIs, and DIs selling the shares to you, and you do not know anything about the company, and you're buying at a really high price because of all the hype that has been happening around these companies when before the listing happens, right? For example, Zomato was listed at $14 billion valuation. Now, how much profits does Zomato make? No, they're not profitable, right? So from where do you get such high valuations? It's primarily for these big investors to get an exit, right? They give you beautiful stories around how this company has so much of prospects, so much of demand, and all of this, and all this is crap. And then you hold on to the crap, which keeps going down, and you lose money. Same way, Paytm was valued at $11.6 billion when it was listed back in December, right, 2021. Now, where is Paytm today? It has lost almost 70% of its value, and we are holding these company shares we are holding, and we are in deep losses. So what has happened basically is these big investors, they overvalue the companies, and then the market realizes that this company is not really worth so much, and then people start dumping the shares. Now, when the people start dumping the shares, price starts going down, and there are so many people ready to sell, the stock price keeps going down forever, right? Sometimes it takes decades, sometimes it takes a few months, sometimes it takes a few years. But the biggest question you have to ask is, where are the profits for these companies? Because of which, why is it valued so high, right? So if a company is valued at $11 billion, it needs to make at least a few $1 million in profits. But Paytm is in losses, right? So you have to basically question yourself, will you buy a company at $11 billion if it is not even making $1 million in profit? That should be the question that you should be asking when you buy an IPO. So my first advice is, do not buy a company if it is not posting any profits. And if there's too much hype around a company, and even if your friend is buying this company, then it is a complete avoid to buy on the listing day. You can buy it before, but not on the listing day. So what you should do? Now here I have a first point which says apply for the IPO before listing. Now companies like Zomato or Nykaa or Paytm, all these companies before listing you might have some premium which you might gain. So let's say a company is listing at 100 and you actually got the IPO at, let's say, 70, right? You still had a good 30 rupees profit and you exit on listing day or whenever you want to. But if you're not allotted the IPOs, then you should not be buying on the listing day. So there are some rules which I've listed here. First is, do not buy the company on the listing day. Do not ever buy a company on listing day, because there's a 99% chance that you will lose money. The share price will go down because of the reason that I mentioned multiple times before. The companies will be overvalued because big investors want to get good exit. So the company is going to be overvalued and investors are going to dump their shares on listing and for the next many weeks and months as well, right? So that's the first point. The second point is, do not, even if you don't buy it on listing day, good, but do not buy randomly just at any point because there's news, because your friends have bought it, or because there is some other news because of which you want to really buy. Do not randomly buy. I'm going to teach you a set of rules today that will really help you. So especially remember this rule: if your friend has bought it and if he's convincing you to buy, do not buy it. Okay, so that's a very, very simple rule, because your friend doesn't know anything about finance, anything about stock markets, and he's telling you some random story which he's read, and you should not be getting convinced to buy the stock. So that's some things. But why should you not buy a company on the listing day? Now, I'm going to talk about some things here which might help you understand why you should not be buying a company on listing day. First is, once a company is listed in the markets, the market is going to take time to understand the valuation. Now remember, pre-listing, the valuation has been done by one company, keeping a lot of things in mind which has been overhyped. But after listing, now the decision is with thousands of investors like us and also people like mutual funds and DIs and all. Now these companies or these shareholders will start either buying or selling, and they will try to determine the real value of this stock in the market for the next few weeks and few months. Now if the company is overvalued, then the price might start going lower and lower. Okay, if the company is undervalued, then the price might start going higher and higher. Now whatever it is, do not buy until the stock starts forming a base. Okay, now or when the stock starts starting to stabilize. Unless the stock price is not stabilized, do not buy. By stabilize, what do I mean? The stock should not be going 40% up in a few weeks, 50% down in the next few weeks. That's not what is stabilizing. Right, now let's identify what is this stabilization of price I'm talking about. Now again here, I'm just taking example delivery here and Nykaa here. Now here if you see, there's been huge spikes in the price, right? The stock went up from 450, almost 616 in just a few weeks, and again a massive drop, again some rise, and again a massive drop, right? Now after these massive spikes, you will see that the stock price now starts to go sideways, right? And the spikes have reduced. The volatility in the price has reduced. And here the price is just going sideways, right? Now when the price starts going sideways, that is what I call a price stabilization or a base formation. Now same thing here, Nykaa also had massive moves up and down. But last few weeks we had the move here and here. Compared to this one here, it is much smaller spikes, and then here also the move has been not very strong, right? So the price is stabilizing. Now I'll show you some more rules around what is a base. Now a base is nothing but when a price after a strong move either up or down, the price starts going sideways. Now in the case of Reliance, the stock went up from 10 rupees to almost 600 rupees in just 10 years, and then the price went sideways for almost 8 long years. Now that's what I call as a strong base. A base is nothing but, just imagine a mountaineer climbing Mount Everest, right? Now these people who climb or hike Mount Everest, they climb a certain distance, and then they put a base camp, they rest, they take all the energy back, they regain all the energy, and then they again start heading higher. It's exactly how a base forms. Now this can happen even on downside. A stock can fall down, then take some rest, go sideways, and again it'll start falling down. Right now, a base is nothing but sideways movement, and the price doesn't have too much of volatility. Okay, now let's move ahead. Now these base can last from few weeks to a few years, and depending on the stock's prior move, the base time period can vary. Now, a base might not necessarily be many decades, but definitely few weeks or few months is something that you would often see. Now, here's a case of Reliance in 2020. We had this massive move up from the COVID lows. We had a few days of base here, then again it went up, a few days of base, again a base, then here it corrected, and again we had a strong base. We had a move up, and then we had a 1 year long base. Now, whenever the price goes up and then it goes sideways, that's what is a base, right? Again goes up, it goes sideways, a base. Here it's a longer base because it's not like the short bases, but here we had a longer base, and then we had a much longer base here before Reliance again broke out and went higher. Now that is what I call a base. Now this is very important to trade IPO stocks. Now the ideal, once a base is formed, then you need to find the ideal buy point for a stock. Now what is the ideal buy point, or how do you identify this breakout point when you have to buy an IPO stock? Now after a base is formed, or while a base is forming, the price should at least be going sideways for minimum 3 to 5 weeks. Now this is very, very important in an IPO stock. If a stock has been going sideways just for a couple of days, no, that's not what a strong base means. A strong base means at least a minimum of 3 to 5 weeks of sideways movement. The next rule is the price should not have crossed the previous high that it was made at least for 3 to 5 weeks. Now, previous high, I'll come to that shortly. Again, the price should not have crossed the previous pivot high for the next 3 to 5 weeks. The last and final rule is the price correction between the previous pivot point and the low point should not be greater than 40 to 50%, right? Anything greater than 30% is a complete avoid. Do not buy. We look at these rules shortly, but the best time frame to trade IPO stocks is on weekly charts, and we're going to buy the stock only when the price crosses the previous pivot. So I'm going to show you a few examples here. The first example is in Happiest Minds, not India Mart, it's Happiest Minds. Now here, what happened in Happiest Minds is we had this first week, I'm on the weekly chart as I said, so on the first week, and then we had a 20-week base. Now this is a perfect example for a beautiful IPO base. Now a stock which was recently listed, and if it does a IPO base like this, in this case 20 weeks base, which is a very strong base, remember the rule, we should have at least 3 to 5 weeks. Now in this case, we had a 20-week base. Now after this 20-week base, when the price crosses this previous high here, that is when our buy is triggered. Right? That's when you buy the stock. You do not buy it on listing day. You wait for it. The market has discovered that this company is already very decently valued, and then we have a push here, and the price starts a major uptrend. Now the buy point, as I said, is above this major base. Now remember, the base is when the price goes sideways, at least for 3 to 5 weeks. Okay, and then the similar way, we had a base on top, and then when the price breaks down, we exit stock. Now let's say you cannot identify these base points using just your naked eye. So then what you could do is, like in this case of India Mart, you can actually apply the pivot points here, right? Now the pivot points here will help you understand what are the pivot points, or what is the previous pivot above which you should buy. Now example here, India Mart was listed on in this day, somewhere in 2020 June, I think, and then we had this nice 6, 7, 8 weeks of base here, and then we had a breakout. Right now, that's the first buy point in India Mart, right? Because we had a beautiful, I think, 10 weeks of base here, we had a breakout, and the price went high. Now let's say you missed this pivot point over here, right? Then you had a pivot point form here on the weekly charts. You had another pivot point, and then you had a breakout here. So you could also buy India Mart at this point with the stop loss around here as well, right? That's the second entry point. Then again, the price made high, but now it hit a stop loss, so we kind of lost the trade. And then again, the price had a breakout here. The price crossed the previous pivot point here after some 10 weeks of consolidation. Again, we had a breakout, and then you buy the stock here, and then finally exit stock here, right? Now you can use pivots like this and also identify the base points. So pivots can help you identify breakout points from bases in a very objective way. It's very helpful, especially if you're a beginner. Let's take a few more examples. Next is this Lakshmi Organic. Here, I've not used the pivot point indicator. You can use it if you want. But here in this case, we had this beautiful, now here we had a straight up move. Remember, this high was already crossed, so we don't have 3 to 5 week consolidation, right? The rule is 3 to 5 weeks consolidation. Now here, we had 2 weeks. Here we had 1 week. But here we had 1, 2, 3, 4, and 5, right? So 1, 2, 3, 4, 5. Now you can sometimes, if you have the 10 weeks of consolidation like this or 8 weeks of consolidation like this, you can also buy, you can ignore these points over here. It's completely up to you. All you need is a tight price action. The price shouldn't have corrected much in that entire move. Here it was just 10% volatility, and then you can buy the stock above this point and then finally exit out on this point, right? That's another example. The last example is Paytm as well. Now Paytm started going in downtrend as soon as listed, so we did not have any buy point anywhere because there was no 5-week consolidation. But finally now we had a massive consolidation here, almost 17-week consolidation. We had a breakout here, right? Or even at this point, right? So you can buy the stock. You could have bought Paytm here, but then your stop loss would have hit here. You should have exited here, and this trade would not have worked. So as always, this is not a holistic strategy. So you need to really practice the rules, and you should train yourself to see basis, pivot points, and then breakouts. So last stock for today, a stock which is actually doing well. I covered this in the Sunday video, but rate gain looks really good, and I think we have broken out from a base, kind of retested. The stock is now in an uptrend, and a beautiful base breakout here, and I think the stock might well do well going forward. So another example is Policy Bazaar. Also, it was in a strong downtrend. It never had a base breakout anywhere. 5 weeks consolidation. Finally, we had this almost 10, 20 weeks consolidation here, and we had a breakout, and we are heading higher. Okay, so yeah, these are two examples from the current scenario. I've covered this on a Sunday video. I hope you enjoyed this video. If you did stay till the end, I know it was a long video. Don't forget to subscribe to my channel and like this video and share it with your friends. Otherwise, I'm going to leave you here. Take care, stay safe, trade safe. Until I see you in another video. Bye bye.